Hey everyone, I am in beautiful Portugal. It was really great because a lot of people messaged me when I took a picture on Instagram and posted that I hit my 12th country McDonald's. It was Portugal. I got a lot of great comments from the people who follow me who live in Portugal. But the last few days have been a little rocky. I think the S&P is on track for its fourth day in a row of losses. Big losses yesterday from the Nasdaq. Guys, there's a lot of talk right now about interest rates. So some minutes came out from the Fed. Two Fed officials wanted a quick interest rate cut, but they were definitely in the minority. The Fed is currently worried about the inflation concerns because of the tariffs. Rightly so. Tariffs are a tax on people. It just bumps up the price and the cost of things. I love how everybody is sitting there saying, look, the revenue the U.S. is getting. Okay, fine. They're getting a lot of revenue, but it's going to pinch everyday people who are buying stuff. Because guess what? Companies are not charities. They're not going to sit there and say, yeah, we'll just swallow it for the rest of the time. They might swallow it temporarily, but it is all likelihood will probably be a hidden tax of some sort. That's a cause of concern that causes inflation. And how do you fight inflation? Not by cutting interest rates. You fight inflation by raising interest rates, as we saw in 2022 when the Fed went from 0% to 5.25% in interest. It was a big jump, but it definitely brought inflation from, well, I think it was around 10% down all the way to recent numbers around 3%. That's pretty impressive. The Fed keeps saying that they want 2% core inflation. You got to remember, core inflation is all the inflation numbers less food and energy. Those are the very volatile prices that are out there. Now, what does that mean for markets? Guys, we have no idea. Because remember, we all thought back in 2022 that if rates skyrocketed, it would drag down stocks. And for 2022, it did. And we've been in a ripping, roaring bull market since then. We've seen companies like Palantir go from $5.83 all the way to $190. It's taken a beating in the last few days, but it's probably it just went straight up from here. Who knows where that goes? And guys, I reiterate, every investment is a present value of all future cash flow. If you love Palantir as a business, if you're buying it for the right reasons and you choose to hold it, I don't blame you. It seems a little frothy right now. It is selling for nosebleed valuations. At one point, I think it was 600 and some times earnings. Yes, it's a fast growing business. Yes, it can increase its cash flow and earnings much faster than a lot of companies. But at one point, it was a $400 or $500 billion market cap. At some point, you got to ask the question, what are we getting for this when we buy this company? Are we just paying for all the future today with nothing left at the end of the day, no meat left in the bone? That is what we're trying to teach on this channel. We're trying to teach a process that when you buy a stock, you're buying a piece of the business. And if you're one of the smart people, like myself and others who watch our channel, who dollar cost average and low cost ETFs for the majority of your money, please continue doing that. The volatility the last few days has not been fun. And guys, guess what? Based on where we are with market valuations today, we are at historical highs, over 100%, 110% overvalued. Not 10%, 110% overvalued. As a reference point, in 2000, with the dot-com bubble, we were 55% overvalued. And the exact same things are being said today that were said in 2000, that were said in the previous bubbles. It's always, yeah, but AI is different. It's changing the world. So did the internet. So did computers. So did every new technology that created a bubble. Now, are we in a bubble? You know, Howard Marks, a guy I adore and think is absolutely brilliant, he's not convinced that the Mag 7 is a bubble. He thinks the other companies are a bubble. What's interesting, guys, is I read some article the other day that the Magnificent 7 companies have the same market cap as the 433 smallest companies of the S&P. So 433 companies of the S&P have the same market cap as the top 7. That's a lot. But guess what? Those bottom 433 generate far more free cash flow than Magnificent 7. That's what's different. Now you might sit there and say, yeah, but the Magnificent 7 is huge. They're cutting edge. It's NVIDIA, it's Tesla. You're right, 100%. But at some point you got to ask the question, what am I paying for? How much am I paying to get a future stream of cash flow in? Guys, I don't care where interest rates are going to be. And the funny thing is, I have 1,000 apartments, and most people who are in the apartment business want lower rates. I do not. I just sit there and say, I don't care what the interest rate environment is. I will adjust accordingly. Now, When interest rates are low, it is a lot harder to buy real estate deals. Why? Well, because a lot of people are making ridiculous assumptions and driving up the price of real estate. Same thing happens with stocks. As a good investor, as a disciplined investor that you are, you want the environment to be harder for other people. Because then if you're prepared, if you understand, if you have a principle-driven approach to investing, you will do better than everyone else. That is the key here. That is what you're trying to accomplish. But the hard part is getting rid of the noise, getting rid of the emotion of everything. It is very difficult for everybody. It's very difficult for me at times. I own Target. Today I just saw a third quarter in a row of declining sales. Okay, that's something to think about. They just got rid of their CEO of 10 years, brought a new guy in. Not a new guy, a guy who started with the company back in 2003 as an intern, now he's CEO. Am I betting that Target is not going to be declining sales forever? Yes, I am betting on that. I look at these things from a long-term perspective. I do not look at my stocks. I have 28 companies that I own. I never look at them. And I really, really reiterate that. I never look at them because we're all going to be emotional about things. Same with the Fed. You've got to figure out a way to say, it's fun to watch these things and to see how the world reacts. But our goal is to stay calm and say, okay, when the market does fall 40, 50%, when the Fed does raise rates, or when they just decide not to even decrease rates, there will be reactions. How are you going to react? You know, it's amazing. Look at Palantir. Somebody was commenting on a Palantir video of ours and said, Palantir, Microsoft, and Meta are the only companies I own. Look at their charts. I sat there and said, okay, with that logic then, when Palantir was at 45 in February of 21, and we told people we would be interested at 5, and it went down to 583, using that logic, you would never bought it. Using that same logic, you should have never bought it at 583. Imagine that logic. A company that was growing, a company that was increasing its free cash flow at a high clip, and you said it was better at 45 than 5. Just think about that logic for a second. With that said, it is very difficult to watch a stock fall, and you start buying it on the way down, and it continues to fall. That's investing. That's why it's hard to be a successful investor, because you've got to think differently. That's the difference with value investors versus the market. Value investors have to look wrong all the time, because when things are rosy, they're more cautious. When things are perceived to be bad, they're more aggressive. So they're always perceived to be wrong in the eyes of the market. Look at Warren Buffett. Longest and best track record in history, and they have every excuse under the sun how Warren Buffett is a moron. He's not a moron. He is not a moron at all. He's going to do very well. That's what we're trying to teach in this channel, guys, is a principle-driven approach to investing. I appreciate your time. Thank you.